move the darn thing. Here you go. Okay. Hope you can see this. I prepared a chart for you, and they can see this, can't they? Okay. All right, so let me tell you what this is. Okay. This is the dot-com bubble right here. That's the dot-com bubble right here. See it? That's the dot-com bubble. 2000, 2001. There's the dot-com bubble. So 95 to 2000. Then she cracked, right? Went down, right? Then they had to create a new bubble. So that's when they decided, they got together and they said, let's create a fake wealth effect. Let everybody think they're getting wealthy. We'll cut rates down on housing. We'll give them all of these liar loans, any kind of loan, make them feel wealthy. It's called the fake wealth effect. Let's make them feel wealthy. So that's what they did. So they gave all kinds of crazy loans. I don't go through all that. You understand all that. And it went up. But it can't sustain itself, okay? And it stopped. None of these can sustain. I'll go over that in a minute, why they can't sustain themselves. So now what happened? She dropped for the same reason that it dropped over here on the dot-com. I'll go over this in a minute. Now look at this bubble. Oh my God. The bubble of all bubbles. Look at this. This is insane. And the reason this bubble is so insane is because it's the first time we started to do stock buybacks, okay? Stock buybacks. Now remember, from 2008 up to, I think it was 2008 up to let me get it here for you. Let me see if I can get this. Give me 1 second. I'll get the other one for you. Let me get this for you. All right, here we go. You watch, today we're going to go negative is my guess. All right, so, oops. All right, so, now remember, now in 2008, right here, 2008, that's when they put $1 trillion in. Okay, so let me put this in right here. So they put in, what they did is front load, they call it front loading a rally. They printed $1 trillion, which takes away from the power of your dollar, makes your dollar weak, and they put in $1 trillion right there, 1 trillion, okay? And the market went up, okay? The market went, and it ended up going up about 80%. Okay, went up about 80%. And then when it started to pull back again, so it went up 80%, and without doing the QE, which this is, and what QE is, remember, is they started to print $4 trillion to go in and buy the treasuries, the 10-year treasury, because what caused this to crash right here, what tipped it over, one of the big things the interest rate that we were paying on our national debt was 3.7%. Okay, that was a killer because we just couldn't afford it. Our economy wasn't growing fast enough, and this whole rally was a fake wealth effect rally. Everything was built on debt. Okay, and then of course people couldn't afford the houses, oil, you know the whole story. So now we went up. So now we're up. Take a look at this. So now they go in and they put in $1 trillion, and we went up 80%. Then they go in and they decide, it starts pulling back again. We better do a QE2. So then they do QE2, and on QE2 they do another 650 billion. So here's 650 billion. So they did 650, and that was QE2. Okay, and that moved the market another 33%. Another 33%. Okay, so you got 33%. So what's moving the market, remember, is injection of money, right? Moving the market 80%, another 650, first a trillion to go 80, plugged in 650 billion to go another 33%. And then finally, they put in, the next one was in right around 2011, that's when they did the next one called the twist. And they did 400 billion. So you got 400 billion right here, another 400. Okay, and that pushed up the market now just 28%. So it wasn't working. It went up 80%, now it's only going up 28%. So now they bring in stock buybacks. And that's when they started to really move this market up. Then they started to do stock buybacks. And that's where we are today up here. Okay, so the last one they did was QE3. We went up around, they put in the last 1 trillion right up here, this area here, 1 trillion, and they went up only 25%. So what was happening is, you can see as they're injecting money, okay, they put in $1 trillion, that gave us 80%. Then they put 650 in, and that only gave us 33%. Then they put in another 400 billion, that gave us 28. And then they said, let's do another trillion, so we go up another trillion, so we go up another 80%. They put the trillion in, only went up 25. They knew they were in trouble. That's when they started stock buybacks, and that was all heavy, and that was right around. They started heavy. They started stock buybacks right out of the gate, but the heavy stock buybacks started in 2010. So here we are up here now. Okay, so now we're up here. This is where we are. Look at the size of this bubble. So bottom line is, this bubble too is going to collapse. Just like they all do, because they all have the same problem. What is that? You inflate by taking money, printing it, and inflating that money, and the printing of that money, that's tremendous inflation, okay? And at some point, what happens, they have to pay that money back. It's all debt, and they've inflated it. And then what happens is, when they start paying it back, we end up with deflation. So that's what happened with all the dot-coms and all that. They couldn't sell any more of that, I forget what they call it, all the, what's it called, the stuff they ran to your houses and stuff. I can't remember the name of it. But anyways, it was over. So now they had to start dropping prices on everything. Fiber optics, thank you. And when you start dropping prices to increase business, you're screwed, because your margins go away. The most important thing in a business is margins. If I'm going to manufacture hats and it costs $5, I sell it for 10, that margin, I got to keep it. And if I'm going to drop the price from 10 down to 8 to do more business, I got to cut costs back here so I can keep that same margin. As long as you keep the same margin, you can cut your cost and your price anywhere you want, but you better cut that cost down, because any good businessman knows you live by your margin, okay? Well, guess what happened? They can't. They couldn't do it with the dot-com. They couldn't do it here, and then it dropped for the same reason. We got tremendous inflation right now. And now the same thing's going to happen. We got so much debt, and our debt is growing 35% faster than our economy can grow. The only thing that's holding this whole stock market up is stock buybacks. Now, what they're worried about, the reason why they stopped selling to get this market to get this from 3.7% down to 1.8%, they bought $4 trillion, $4 trillion in treasuries. They were buying like $65 billion a month. So from 3.7 down to 1.8. That way they could drop the cost of interest of 350 billion on the debt down to 180 billion on the debt. They have to drop that interest rate. It was killing them. So, but the problem to do that, the Federal Reserve now has on their balance sheet, went from 450 billion to 4 trillion. Now the problem is they said we better start selling these treasuries because we're back up here now. Our interest rate right now has been at what's our 10-year now? 10-year now is at 2.72, 2.62. So 2.62, okay, they got to get this interest rate down. So what's going to happen is they can't because they're topped off, because they went from 400. Okay, so think of it this way here. They went from 400 billion, okay, up to 4 trillion. Now they're topped. They can't do that anymore. Okay, they can't. If this next crash is happening, they've got to make room. So they had to start selling treasuries to bring that 4 trillion down to at least to 2 trillion, like this. So they need to get the 4 trillion down to 2 trillion. So when the market crashes, they can do the same thing now as they did in 2008. They buy treasuries to drop the interest rates down to about 1%. They're stuck right now. They can't do it. And what happened is they said as they started to sell the treasuries, they had to stop because the economy is so weak. When they stop selling, when they sell treasuries, the interest rates are going up. And it was the interest rates that took our market down. Okay, so that's the big problem. It was the interest rates that started to take our market down, and so now they got a problem. The short-term interest rates, they moved from a quarter point to 250 points, and the 10-year Treasury yield, which is the long-term yield, which is what we pay interest on our national debt and what you have to pay for a 30-year fixed-rate mortgage, both were going up. But wages aren't going up enough. The economy's not growing enough, so we're really screwed. So we're setting up the same problem that we had here. The deflation will start hitting here. Deflation will hit. Now, when does deflation hit? When you keep inflating the market up by printing money and doing stock buybacks, at some point, the corporations now owe $9 trillion. They owe $9 trillion in debt, the biggest debt ever, and that $9 trillion came about from what they do. Stock buybacks. They got to start paying that $9 trillion back. You got household debt, historic 13 trillion. So you got household debt at historic 13 trillion. That doesn't count the automobile debt at over $1 trillion, the first time in history. Credit card over $1 trillion, first time in history, and student debts over $1 trillion, first time in history. So you got all those. You got the trillion. Add that on top of the 13 trillion, and then you got the national debt that's at 22 trillion. And Trump, with that tax cut for all the corporations, that's going to add another 1.7 trillion on top of the 22 trillion. So that, because we're going to have a deficit now over the next 10 years, almost $1 trillion I think it's like about $1 trillion a year, they're saying. But anyways, so what's going to happen for us as traders, we know it's just a matter of time before deflation hits. You got to start, see, at some point you got to start paying your bills back, your credit card back. Everybody's got to start paying their debt back. The corporations got to start paying their debt back. So when they start running out of money, then what happens is the economy slows. It slows down. It starts dropping down. So what do you have to do to get the economy? You have to sell stuff again. So what they do is drop prices. That's what they did over here with all the tech stuff. They started to drop prices. That's deflation. Housing. Remember when they all started to drop their housing prices? You couldn't even give houses away. Remember Kudlow came out and said, oh, there's no problem with housing. Prices are going to be. And then remember when Bernanke came out and said, I've never seen housing. We're never going to have a housing crash. I've never seen housing prices go down in the United States. Well, they started to go down. That's deflation. Then people start laying people off. Okay? That's exactly what we're setting up for right now. The only thing that's holding us up, and look at the size of the bubble. The only thing that's holding us up, the difference, is that we weren't using the stock buybacks with the dot-com and the housing com. And look at the difference in the rally. See the difference? How out of whack that rally is? So they just announced the other day they're going to do another 900 billion in stock buybacks for 2019, the same as they did in 2018. So they just won't give it up. Well, that means what's going to happen now is these corporations are going to even get more in debt. This means the corporations are saying, well, instead of borrowing the 900 billion like we've been doing, where we got debt of 9 trillion from borrowing all that money to do stock buybacks, we're going to take it out of our cash flow because they can't afford to borrow it anymore. They're tapped out. Well, what does that mean? That means if they can't borrow it because they can't afford to borrow it to buy their own shares back, they're going to take it out of cash flow. What does that mean? That means all the labor in this country is screwed because they can't get raises, because now companies are going to take it out of cash flow. At least it used to be when companies borrowed money, they would borrow it, they go buy, they put some in capital investment, new equipment, new machinery, and productivity would go up, and that's how you get a raise. Well, now there's not going to be any money going into capital investment. And remember Larry Kudlow came out and he said, boy, capital investment is screaming. Capital investment is really robust. And then what did we find out? He lied. It wasn't robust at all. It was diving. As a matter of fact, we had a couple of cuts I did on the radio show. So that's where we stand right now. So what do we do as traders? Well, now what we're going to do as traders, that we have this knowledge, and that's why we love charting,